Welcome back to the deep dive. You sent us a mountain of material on the U.S. auto sector, screeners, financials, expert analysis, and we've been digging through that data stack, really trying to pull out the absolute must-know insights for you. Our mission today, to really get into the top 3 high-volume U.S. auto manufacturers. Rivian, that's RIVN, Tesla, TSLA, and Ford, F. We're looking at, the fundamentals, the technical momentum, and crucially, the news that's actually moving these stocks.
Yeah, and it's a critical time for this dive. The auto sector is, frankly, a battlefield right now. You've got EV shifts, supply chain issues, tariffs. It's messy. So we're going to synthesize all these detailed data points, valuation, liquidity, technicals to give you a comprehensive picture of what's driving things. And just quickly, as always, this is purely for informational and educational purposes. We're digging into the sources you provided, the figures, the scenarios. They're analytical tools, not investment advice. Just exploring the data together.
Okay, perfect. Let's jump right in. First up, Rivian Automotive. Rivian. This one really popped on the screeners recently. It closed at $15.42 after just a massive day of trading. What was it? Nearly 200 million shares.
Yeah, huge volume. And that resulted in a staggering one-day price jump, 23.36%.
23% in a day. That's more than just a rally. It feels like a major market rethink.
It's definitely momentum, but we have to ground that excitement a bit in the financials, right?
Okay.
Rivian is, the textbook definition of high growth, but also non-profitable right now. Look at the earnings per share. Trailing 12 months, it's negative $3.11.
Oh.
And the profit margin is deep in the red, minus 61.34%. They're, burning cash to build.
So if they're losing money hand over fist like that, why look at the fundamentals? Does it matter?
Oh, it absolutely matters.
Yeah.
Because they have a pretty significant safety net. Their balance sheet shows surprising liquidity for a company in this spot. The current ratio is strong, 2.71. Quick ratio is 2.23.
Right. So just to clarify for everyone, a current ratio of 2.71 means for every dollar Rivian owes in the short term, they have about $2.71 in liquid assets ready to go. That's a big cushion for an unprofitable manufacturer.
Exactly. A massive margin of safety. And their debt-to-equity ratio, 0.98, is actually quite manageable for a company building out factories and scaling up. The market isn't valuing today's profits here. It's all about the future potential. You see that in the price-to-sales ratio, 3.21, and the expected 5-year EPS growth, a predicted 19.23%. Investors are buying the dream.
Okay, so what was the spark for that 23% explosion? The news reports confirm a Q3 revenue beat, driven by deliveries. But here's the interesting part. You flagged that surge was partly a pull forward. Buyers rushing before some EV tax credits expired.
Right, a bit of a sugar rush, perhaps.
But the other key trigger, the one that seems to fuel the long-term faith, was the confirmation. The R2 midsize SUV, the Big Hope, is officially on track for 2026.
So you have this mix, don't you? Short-term success may be boosted by temporary factors, combined with huge excitement about the future pipeline. But the counterpoint for the skeptical investor is still there. Despite higher revenue, the quarterly loss actually got wider.
And technically, this stock doesn't just move, it feels like it bungee jumps sometimes. High beta, 1.82.
Yeah, meaning it moves way more dramatically than the overall market and its weekly volatility, 7.51%. Significant.
The price action, though, $15.42. Closing price, it's getting close to that 52-week high of $17.15. And it's trading well above its 200-day moving average, plus 17.29%. That screams technical breakout.
It does. Let's make that volatility real with a quick paper money exercise. Say you jumped in at the 52-week low, $9.50, with $5,000. That gets you 526 shares.
Okay, 526 shares. If you sold those at yesterday's close of $15.42, your $5,000 would be worth $8,100.12. That's a paper profit of $3,100.12. That's 62% gain. Not bad for riding that wave.
Not bad at all.
Yeah.
So the picture for RIVN, cash-rich, good liquidity buffering losses for now. It's a pure faith play, really, that pays off big when the news hits right.
All right, so that's the volatile challenger. Let's shift gears to the giant in the room, Tesla. TSLA. Market cap over $1.5 trillion. It's just priced differently. Closed up 4.01% yesterday at $462.07.
And the valuation metrics, they immediately set Tesla apart from any traditional automaker. It's almost a different category. Look at the price-to-earnings ratio, 308.75.
300 times earnings.
And price-to-sales is 16.07. Compare that to Ford, which we'll get to.
Right. We mentioned Ford's PE is around 11, so you're paying, nearly 30 times more per dollar of earnings for Tesla? That difference is the story expectations of massive future growth, way beyond just cars.
Exactly. It's a bet on tech, on AI, on the whole ecosystem.
Market
expects huge growth, 32.43% EPS growth growth projected for next year.
Hmm.
But there's friction now. Their recent EPS actually contracted quarter over quarter, shrank by 37.16%. Now, they are profitable, unlike Rivian. Profit margin is 5.51%, which is decent for the sector, and debt to equity is impressively low at 0.17. But that growth narrative, it's hitting some bumps.
And the immediate bump seems to be all about governance, isn't it? The news is just full of the shareholder vote on Elon Musk's huge pay package. You've got big players like the Norway Wealth Fund opposing it. The framing is literally the future of Tesla hinges on this.
That uncertainty is layering on top of some recent operational issues, too. Q3 earnings missed estimates, and reports point to slowing shipments in China, which is a crucial market. Plus some general AI valuation jitters affecting tech-heavy stocks.
So operational headwinds and this massive governance question mark, how does that translate technically?
High volatility again. Beta is 1.87, even higher than Rivian's, very sensitive to market mood swings. And the average true range, ATR, that measure of daily price movement, $19.85.
It was almost $20 a day on average. You really need an iron stomach for that kind of ride.
You do. Technically, though, despite the recent noise, the stock is highly extended upwards. Performance over the last year is plus 85.59%, and that price, $462.07, is a whopping 36.87% above its 200-day simple moving average. That's sustained, powerful momentum.
So what did that incredible run mean for someone who timed it well? Let's do the paper money again. Buying at the 52-week low of $214.25 with $5,000, that would have netted you 23 shares.
Okay, 23 shares. Selling those at yesterday's close of $462.07 turns your 5K into $10,627.61. That's a paper profit of $5,627.61, a gain of 112.55%. Just staggering.
So with Tesla, the insight seems to be, yes, the valuation looks detached from auto norms, maybe even current reality, but the market's belief in its tech dominance and future scale has delivered absolutely outsized returns, even with serious headwinds now.
Well put. Now, shall we hit the brakes and look at the legacy player? Ford, ticker F.
Yes, let's ground ourselves. Ford closed at $13.11, up a respectable 2.50% yesterday. And interestingly, it has the highest average daily volume of these three, around 87.7 million shares. Rivian had that one massive spike. But Ford sees consistent broad interest day in, day out. It's the industrial heartbeat.
And it trades at completely different levels. Traditional value territory, PE is just 11.24. Price to sales is incredibly low, 0.28.
0.28. That means the market values its total annual sales at less than a third of its market cap. Signals maybe it's seen as mature, possibly undervalued based on revenue alone.
Could be. And a big draw, completely different from the other two, is the income.
The dividend.
Absolutely. A strong dividend yield of 5.10%, paying $0.60 per share over the last year. That attracts a different kind of investor. But it is heavy industry. The financials show that. Debt to equity is much higher, 3.47. Long-term debt equity is 2.24. That's typical for traditional manufacturing with massive physical infrastructure.
Right, they use debt differently than, say, Tesla.
Correct. But current performance is strong. EPS grew 172.30% quarter over quarter recently. That's impressive.
So what's driving Ford right now? The reports highlight the strength of their traditional business Ford Pro, the truck and commercial side. It's booming. That strength is basically covering for the drop in EV sales after those tax credits expired, a major headwind they're managing.
They also seem to handle that Novelis plant fire issue well, confirming it would reopen, which helped them beat Q3 earnings, showed some resilience.
But here's a point of tension you noted. The average analyst target price is $12.19.
Right, which is below the current market price of $13.11.
So the market sentiment right now is actually more positive than the consensus analyst valuation. Suggests maybe the momentum is carrying it a bit beyond traditional targets?
That's one interpretation, certainly. The market is buying the current performance and perhaps overlooking some analyst caution.
And technically, Ford is a much smoother ride compared to the others.
Relatively speaking, yes. ATR is only 0.37 cents. Still, volatile beta is 1.60, so it moves more than the market, but definitely less jumpy day-to-day than RIVN or TSLA. It does show good medium-term momentum, though. Price is 21.60% above its 200-day moving average. And while it's getting near its 52-week high, $13.97, it's come a long way up from the low, $8.44. Investors have clearly been buying into this recovery story.
Okay, last paper money run. buying Ford at its 52-week low, $8.44, with $5,000, that gets you 592 shares.
Selling those 592 shares at yesterday's close of $13.11 makes the pot worth $7,770.32. So a paper profit of $2,770.32. That's a solid 55.41% gain. Less explosive than Tesla, similar ballpark to Rivian's low-to-current run, but arguably built on a more traditional foundation.
Right. So for Ford, the resilient value play, strong dividend, traditional segments carrying the load while it manages a slower debt-funded EV transition.
Okay, so let's pull it all together. We've really dissected three very different beasts here. You've got Rivian, high growth potential, super volatile, but cash rich, living on momentum in the hope of the R2. Then Tesla, the leader with that extreme tech valuation, high volatility still, but facing real governance and production questions right now, despite incredible past performance.
And Ford, the traditional industrial player, offering value metrics, a solid dividend, using its legacy strength, especially in trucks, to navigate the future, albeit with more debt. The paper money examples really hit home how much you could potentially gain by catching these swings, but they also highlight the totally different risks you're taking on. Astronomical PE ratios versus heavy industrial debt.
Exactly. The sector is clearly split. Investors are forced to choose. Are you betting on pure tech-driven growth like Rivian and Tesla, or the steady income-generating value of Ford? And that brings us to a final thought, maybe something provocative for you to mull over. Think about this. Rivian's recent big jump was partly tied to people rushing before EV credits ended. Ford's current strength is driven by booming gasoline truck sales. So the question is, what fundamental shift in consumer tastes, in policy, whatever needs to actually happen for these next-gen automakers like Rivian to consistently win based on solid, repeatable fundamentals, not just technical bursts or temporary incentives? When do they stand on their own against the legacy players' core strengths?
That is the multi-trillion-dollar question, isn't it? What actually tips the balance long-term? Fascinating stuff. Well, thank you for sending in all that material for us to dig into. It's been a real deep dive. Until next time, keep exploring those complex profiles.